In this video, we're going to look at closing entries. There are some important reminders that we should look at before we get into our example. Only temporary accounts are closed at the end of the fiscal year after the financial statements have been prepared. Temporary accounts are accounts that only track information for a one-year time frame. Closing the account means that the balance in the account will become zero, and the accounts that are closed are our revenues, expenses, income summary, and dividends, or that phrase that I gave you in class of REID, R-E-I-D. The accounts that you see on your balance sheet are never closed. So all of your assets and contra assets, your liabilities, common stock, and retained earnings are not closed. Those are permanent accounts and their balances carry over to that next start of the fiscal year. Income summary and dividends are going to be closed out to the retained earnings account. It's going to affect retained earnings, but retained earnings is not closed. The income summary account does exactly what its title says. It summarizes what you see in the total column on your income statement. And if we think about our total column on our income statement, what we see is our total revenues, our total expenses, and the net income or net loss for the period. And that's exactly what we're going to see in the ledger for our income summary account. Only income statement accounts, revenues and expenses, can be closed to income summary. Again, think about the title of income summary. It's a summary of our income statement. So only revenues and expenses can be closed to our income summary account. The income summary account and dividend account are closed to retained earnings. What this process does is journalize what we see on our retained earnings statement. We know that we start with our beginning balance in retained earnings. We add in our net income, or if we had a net loss, we would subtract it away. And we subtract away our dividends. We will do the same thing in our journal. We will have our dividends reduce the value of retained earnings, and we'll have our net income increase the value of retained earnings. If we happen to have a net loss, it would also reduce retained earnings. So now let's get into our example. It tells us that after the accounts have been adjusted at April 30th, the end of the fiscal year, the following balances were taken from the ledger of Nuclear Landscaping. So they're telling us that our current balance in retained earnings is $643,600. They tell us that our dividends account is at $10,500. We have one revenue account, which is our fees earned, and it currently has $356,500 in there. We have our wages expense account at $283,100. We have our rent at $56,000. We have our supplies at $11,500. And finally, we have our miscellaneous expense at $13,000. So we need to journalize the 4 entries that would be necessary to close those required accounts. Again, think about that phrase REID. We're going to close our revenues, then our expenses, then our income summary account, then our dividend account. So now let's journalize our closing entries, and we're going to post them to our ledger so we can see how the closing process works. So all of our closing entries are dated as of the last day of the fiscal year, and for this problem, that is April 30th. First, we're going to start with our REID. So we're going to start with our revenues. We're going to close our revenues first. Our revenues, we know, increase with credits, which means in our ledger, they would have a credit balance. If we want to make the balance in our fees earned account zero, we just simply need to do the exact opposite to what the balance currently is in the ledger. So our fees earned currently has a credit balance of $356,500. So if we want to make it zero, we're going to debit it. For the same $356,500. Our fees earned is a revenue account. It's on our income statement. So that means that our fees earned account gets closed to our income summary account. And we will put our $356,500 $500 directly into our income summary account. Now let's post that to our two accounts, fees earned and income summary. So we go to our fees earned account, account number 41 on 4/30. This is a closing entry. We'll say that it happened on page 5 of our journal. And what happened is there was a debit of $356,500. We know that when there's a debit balance, a credit balance rather, and a debit transaction, opposites subtract. So we have a credit of $356,500, a debit of $356,500. It makes the balance in our account 0. We have just closed our fees earned account. Our income summary account was also affected on 4/30. It was a closing entry. It happened on page 5 of our journal. And what happened was it was credited for that to $356,500. So we enter that in. And it becomes our balance of $356,500 because there's nothing to offset that balance at this time. We now need to go ahead and close our expense accounts. So again, on 4/30, we're going to close our expense accounts. Our expense accounts increase with debits, which means that in their ledger account, they have debit balances. If we want to make those accounts 0, we're going to have to credit each one of those expense accounts. Expenses are on our income statement, so that means they're going to get closed out to our income summary account. So we're going to come back to that account in a minute. We're going to credit each one of our expense accounts individually. So we had wages expense. We're going to credit it for the $283,100. We also had a rent expense. We're going to credit that for the full $56,000 that is sitting in the ledger account for rent expense. We also had a supplies expense. And the supplies expense balance was a debit of $11,500, so we're going to credit it to close it out for $11,500. The amount of $13,000. So now we simply need to add all of those accounts together. So we have a $283,100 for wages, we have $56,000 for rent, we have $11,500 for supplies, and we have $13,000 for our miscellaneous expense. So in total, we have $363,600 in total expenses. So that's what we're going to debit our income summary for, $363,600. Now let's post those transactions to our ledger for our income summary and all of our expense accounts. So income summary again was affected at the end of our fiscal year with the closing entry. And we debited that account for a total of $363,600 for total expenses. There was a credit balance. It's now being debited. We know opposites subtract are greater than our credits. It's going to change our income summary account to a debit balance of $7,100. This is representing the fact that our expenses exceeded our revenues during the period, and therefore there was a net loss for this company. We also have to close out all of our expenses. So on 4/30, we have a closing entry that happened on page 5. We're crediting it for $283,100. We know a debit balance and a credit transaction opposites subtract. It makes our balance 0. We've now closed out that account. We'll do that same process. Credit the account for $56,000, making the balance in the account 0. We've closed out rent expense. Supplies. Again, we have credited it for $11,500. Opposites subtract. We've closed out our supplies expense account. And finally, for miscellaneous, $13,000, we credited that account. We're at 0. We put in our post-reference numbers here. We've updated account number 41. We've updated account number 33, 33, 51, 52, 53, and 59. We have successfully closed our revenues and our expenses accounts. So again, if we're thinking about that phrase of read, revenues and expenses are closed, now we have to close income summary. So let's go back to our ledger for a minute for that income summary account. So income summary currently has a debit balance. If we want to make it zero, we have to do the exact opposite. And in this case, we are going to credit that account for $7,100. The debit represents that there was a net loss for the period. And we know net losses reduce retained earnings. So in order to reduce retained earnings, we debit it because it's a stockholder equity account. So we're going to reduce it by the $7,100 that's in the income summary account. And we're going to close our income summary account by crediting it for $7,100. Let's post those transactions. So on 4/30, again, it's a closing entry on page 5. We're going to credit the account for $7,100, making the balance in the account zero. We've effectively closed our income summary account. Now let's post to our retained earnings account. So on 4/30, we have a closing entry on page 5. And again, we are closing out income summary into the retained earnings account, but we are not getting rid of the retained earnings balance. We're not closing out that account. We're simply adjusting it for what took place during the period. So we need to debit that income summary, that retained earnings account by $7,100 in order to update that balance for the net loss that was incurred during the period. So credit balance, debit transaction, opposite subtract, it updates our account to be $636,500. So we've updated account number 31 and we've closed out account number 33. So our last letter in read is our dividend account. Our dividend account has a normal balance of a debit because that's how we increase the account. So if we want to close out our dividend account, we are going to credit it. And retained earnings is going to be affected negatively again. Think about your retained earnings statement. We have two items that change the value of our retained earnings balance from the beginning of the year to the end of the year. And that's whatever happened on our income statement, meaning a net income or a net loss, and our dividends. So these last two closing entries are journalizing those changes that we see on our retained earnings statement. So retained earnings is being reduced by the $10,500, which is the balance that's in our dividend account. And we're going to close out our dividends by crediting it by $10,500. So retained earnings, we have a closing. We are debiting it for $10,500. We had a credit balance. This is a debit transaction. Opposites again subtract, so we are left with $626,000 as our ending balance in retained earnings. This $626,000 should match what you'd see on your statement of retained earnings as the ending balance in that retained earnings account. The $7,100 should match what you had on your income statement as a net loss. And we close out our dividends with a credit for the $10,500, making the balance in the account zero. Again, there's a lot of checks and balances that are put in here. So if you're doing your financial statement first, make sure that what you are closing out to retained earnings represents that net income number, and your ending balance in retained earnings matches what you see on your retained earnings statement. Same thing goes for your income summary. What we should see in our income summary account is the summarizing of what we see on our income statement. We would see our total revenues, total expenses, and a net income or a net loss. That's exactly what we're seeing in our income summary.